Picture this, it's 2 a.m. You're alone in the room and only lit by the harsh glow of your screen. Staring at this number seems to mock you. Your heart sinks as you realize you make a major trading loss. Hi, my name is Cody. I'm a 7-figure stock option trader, and I'm gonna show you a real-life example of when my account went down by 10% from the market rally in June 2023, and the strategies and mindsets I used to handle this potential worst-case scenario. I'm gonna be giving you full access to my account, all the live trades and strategic decisions I make during this time. Now let's get started. So I'm gonna be relived the 2 weeks of roller coaster ride in my account from June the 7th to June the 24th. So on June the 7th, my account was at 24.36% up. Fast forward to June 15, my account went down to 15.54%. And fast forward to June 23rd, my account went back up to 24.5%. As you guys can see on the screen, the S&P 500 index from June the 7th, it was at 4260, and then until June the 15th, S&P 500 is around 4370. By June the 23rd, S&P 500 is at 4362. On June the 2nd, VIX is reaching its 1.5-year low since COVID. So it's ranging around 14 to 15. And the average for VIX, which is the volatility index, has been ranging between 16 to 20 for the last 30 years. So when it's lower than 16, that means that there's less volatility and less uncertainty in the market. And just a side note, by that time, my account was making 29% for the past 8 months. That's averaging about 3.7% per month.
Hey guys, really quick, I just want to give you guys a reminder that every time I say a bear put spreads in this video, I'm referring to bull put spread. I only introduce bull put spreads concept in this video. Okay, back to you guys.
I decided to put on a neutral to bearish position called bear call spread because I see a major resistance right above at 4330 for the S&P 500 index. While I was putting on this bear call spread, which is a neutral to bearish position, I was thinking that the market would stay bearish or neutral. It turns out the market continued to rally. I can put on a bear put spread, which is a more neutral to bullish position to balance out my bear call spread and turn it into an iron condor. So fast forwarding 6 days from June the 7th to June 13th, the market continued to rally from 4228 to 4350. So the market almost went up by 100 points. So I got slapped right in the face. And that's when I used my plan B of turning my neutral to bearish position into a more neutral position by opening up a bear put spread, like I just said. When I opened a bear call spreads on June the 7th, I got paid a credit of $550. Since then, market went up for about 100 points in 6 days. So like I said, I stick to my plan and I open up my bear put spreads, which pays me 6.5. So balance out the delta. So now the position is not as bearish and is more neutral. At that time, I thought, hey, now the market already blew through the major resistance, maybe it will pull back a little bit. Now that I have a bear call spread I open on June the 7th and I have a bear put spread I open on June the 13th, now all these two add together is what's called iron condor. And now it's fast forwarding to June 21st. My bear put spread, the bullish position, is at 40% unrealized profit, whereas my bear call spread is at negative 20% unrealized losses because the market continued to go up by almost another 100 points. So in this case, I got slapped in the face and continue to get slapped, but I think I would just roll with the market. So what I did is I closed my bull put spreads at 40% of the profit. Then I opened another bull put spread that's a higher end strike price so that I still have the same delta and still get paid another credit just in case the market continued to move up. So up until this point, I opened a bear call spreads on June the 7th. I opened a bear put spreads on June the 13th, turned into iron condor. And now on June 21st, I closed the bear put spreads in the iron condor and open another bear put spreads. So it's still an iron condor, just that the delta for the bull put spread is a bit higher. At that time, I thought the market will finally pull back a little bit to 4300 because that's a major support. And also another reason why I closed my bull put spreads and open up another bull put spread with a higher delta is if the market continued to go up and challenge my bear call spread, the new bull put spread will continue to collect profit and hedge the realized losses from the bear call spread. So fast forwarding, my account went from 24% on June the 7th down to 15% up on June the 13th, back up to 24% on June the 23rd. And my iron condor is about 21 days to expiration, and the profit is between 50 to 70% unrealized profit. So I decided to close the position because the VIX, which is a volatility index, is ranging around 13 now and is already below the 14 and the 15, and this is at the lowest level since COVID. When the VIX is below 15, this is when I'm very cautious. I'd rather take profit and not do a lot of activity, because when the VIX is low, the VIX can spike anytime. When we're option seller, we want to sell option when the VIX is high, and when the VIX is low, generally I only deploy up to 25% of the capital in my account. That means if I have a $10,000 account, I only have $2,500 in the position. Hey, if you enjoyed the real behind the curtain roller coaster ride of our hedge fund said and done strategy, click on the link in the description to watch our full case study. And next, I want to make sure you can implement these yourself as well. But first, I need to introduce the basics so you can implement the strategy. To start it off, the rate of return is the speed you can get to your own version of financial freedom. So the higher it is, the faster you will get there. The different ways that buying stocks and getting paid dividend and wait for the equity to go up, or you can go sell the put options on a stock you want to own anyway at a discount price and then sell cover call against it once you own the stock and continue to own cash flow while you're waiting for the stock to appreciate. Now, what I'm introducing here is the more advanced version of selling put option and selling call option, is what we call the bull put spreads and the bear call spreads. I'm just gonna introduce the bull put spreads, and everything is a mirror for the bear call spreads. When we're selling put options, we're ready to own the stocks at a cheaper price. And hopefully these are good stocks, blue chip, and long term it will go up. But when we're selling a bull put spreads, now we have the option that we don't have to own 100 shares of the stock. Why? Because we not only sell a put option, we also buy the put option with a lower strike price. What that means is that the difference between the strike price is the maximum amount of losses we cap it at. So that means the difference between the two strike price times it by 100 is the maximum amount of losses we'll be taking. And selling bull put spreads or bear call spread is still a good strategy to act as a casino owner with an insurance broker, where you have a high probability trades, because when you're selling a bull put spread, that means you can make money even if the stock goes down a little bit, stays the same, or go up. So the chance of winning is really high. On the all-time money list for the top poker player, make $60 million last year. Last year alone, casino around the world makes billions of dollars. Imagine our selling bull put spread strategy will allow you to become the casino, where you just have to deal with the cards and collect the money every round of the game. Selling put options or selling bull put spreads has a reputation of being risky. But if you focus on quality stocks, or even like myself, I only focus on the S&P 500 with the less volatility than any of the individual stocks. And S&P 500 has been historically going up by 8 to 10% for the last 90 years. This strategy has become a lot less risky. This strategy might be going against the normal, but the normal investing strategy has people retire in their 60 and 70. And I want you to reach your own financial freedom a lot sooner than in your 60 or 70. Now we're gonna go into the terminology you need to know to start implementing bull put spreads. The first thing you need to learn is put your finger on the like button and subscribe so you will reach your financial freedom sooner. So selling a bull put spread is a lot easier than you might think. First, let's talk about what an option is. An option contract gives you an option to buy or sell in stocks at a certain price and on or before a specific date. There's two types of options, call and put options. If you buy a call option, you're expecting the underlying stocks or index to go up in price. If you buy the put option, you're expecting the vice versa. With the bull put spread strategy I'm introducing you, you're not only selling a put option, you're also buying a put option at a lower strike price. This strategy will allow you to make money whether the stock goes up, goes down slightly, or stays the same. You also need to know about the strike price. This is the predetermined price you buy or sell the stocks at. And you also have the expiration date. You need to sell or end your position on or before this date, or let it expire higher and keep the premium. And here comes the best part, the premium, also known as the time value or theta decay, where you're buying the time value for the stocks to move in your favor. The price you pay for the option is called the premium. Each contract consists of 100 shares of the underlying stocks. Now, if you're selling a put option, you're on the other side of the table. You're selling time value to speculator. You will receive the premium as income. Selling put options allows you to become the casino now, which is dealing cards and collecting the fees. So when we combine selling put option and buying put option together is what we call a bull put spread. So when we sell a put option, we receive a premium. Then we turn around and buy a put option with a lower strike price and we pay a premium. In the case of a bull put spread, the premium we receive from selling the put option is higher than the premium we pay to buy the put option. So in that case, even if we don't do anything until the expiration date, we can keep the profit. So in this case, we receive a credit right up front when we sell a bull put spread. It might seem confusing at first, so I encourage you to watch through this video a few times and take notes. Don't get discouraged. This information is very valuable and game-changing for your financial journey. If it's still going over your head, you should watch my most viewed video here. It's most viewed for a reason because it will help you understand all of this. There you have it, my roller coaster ride and 2 slaps in my face, and I'll see you on the next video. Say yay.